it really came down to what they call founder risk, right? Which is this founder going to flake? Are they going to be able to handle the pressure? Are they determined? Can they lead a team, recruit people? Can they be coached? Which is a huge one that a lot of folks don't talk about. But I think that being coachable as a founder is like.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. And today we're talking with Zack Oliva, and we're talking about the markets and investing and value investing. And what's the future for value investing? And is it still relevant? And will you actually be able to make relevant decisions? And there was something at the very end of this episode that you're definitely going to want to hear. It made me laugh, but it's really relevant. It talks about who makes the most money long term when it comes to investing. So stick around. As always, give us a like, a subscribe, and share, and let us know what you think about this episode. Take care.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. I'm here today with Zack Oliva. Zack, how are you doing today?
Doing great, Jeff. How are you?
Doing great. Thanks so much for being here. Really appreciate it. Looking forward to getting into your background here. You have a lot of history here when it comes to business and entrepreneurship and investing and working with high net worth individuals. So I'm really excited about that. But before we do that, why don't we go ahead and tell folks a little bit about how you got to where you are today?
Sure. So I'm a lawyer by training. In 2013, started a law firm in the oil and gas industry with a partner. And today we have around 100 employees. We work with oil and gas companies all around the country. Through that, got asked, over the years, hey, we're doing a startup. We think we need a lawyer. Can you join us? And so that's how I kind of got into the startup and angel space, I guess, and sold out of some of those investments. Did a little bit of venture investing. And a few years ago, I started Oliva Partners Management, which is a long only investment firm that focuses on value investing. And the reason that I started that is because I've been, a huge fan of Warren Buffett and value investing ever since probably before high school. Had always done it on my own. And I hated filling out all of the paperwork for all of these angel investments, venture investments, et cetera, that I had. And so I just decided to consolidate everything in one place. And that became Oliva Partners Management, which, really works with high net worth individuals, accredited investors around the country.
Beautiful. Wonderful. So do you guys still do oil and gas investments?
So I only buy equities in the portfolio. And some of those, especially like during COVID, where there were some oil field services companies that were trading incredibly low, we made some really good money in those oil and gas service companies. I prefer to not invest in oil and gas operators because sometimes it's kind of hard to get them to fit the criteria that I have for the investment fund. Um, we've made some investments in coal a year or two ago, which I think is still trading incredibly cheap. The metallurgical coal, not the thermonuclear coal. And it's kind of a hated investment in the United States because it's dirty, right? And the whole country is kind of trying to shift more towards natural gas, clean energy. And, the coal investments, especially with the metallurgical coal, that is what we use to make steel. And so that's not really going to be going away anytime soon. So those are some of the energy investments that we've made.
Awesome. Well, I asked that because it's such a shift from starting out in the legal world for oil and gas and then shifting over into, venture investing and things like that. So I was always curious if there were still ties back there, but that's awesome. Yeah. And there's energy's not going away, right? Anytime soon. I can't imagine that we're going to come up with some, newfangled approach. I was in nuclear power for a long time. I
Uh-huh.
inspected coal-fired power plants. I inspected natural gas turbines and things like that. And, there's always going to be a need for power and it's just growing at a rapid clip. So I was just curious if you guys stuck to your roots at all or if you've
No,
expanded out into a lot of other things.
I love working in the oil and gas industry. I've met, some of my best friends, and we've been able to do amazing things for our clients in the law firm. In the investment fund, it's pretty much an all-weather fund. I mean, it really depends what's trading really low and what's an investment that we can make for the long term. For a little bit, I did a lot of deep value investing for a few years, both personally and in the fund. And that was buying companies that were not great companies when they were trading at like bargain basement prices. And really, the goal with those is to get as many as you can because you're not quite sure which ones are going to work out. The problem that I ran into with those, I think the problem that exists with those is obviously when the market is high, like it's been the last few years, there aren't that many.
Mhm.
And additionally, um, when you invest in those companies, you have to get the buying right and the selling right because these aren't companies that you want to be in for 10, 15, 20 years because they're not great companies. That's not why they were trading so low. And so as I started to think about the future of this investment fund, and I really wanted to move more towards a system that would really reward me for making a few great decisions and just let those decisions compound over time. And so that's why when we switched the strategy of the fund, or like I like to say, upgraded the strategy of the fund to great companies, which, today, this week, and maybe in the coming weeks, will continue to be on sale.
Very cool. All right. So you mentioned a couple things in the beginning in your intro about value investing, and I believe it was Benjamin Graham wrote The Education of a Value Investor, right? Which was one of those books that I read along with Snowball, Warren Buffett,
Mhm.
and it all makes perfect sense, right? But today we're seeing such massive trends and shifts towards AI, towards high frequency trading. This has been a trend we've been seeing a long time now. Is there still a place in the world for value investing? And can you explain what that means for people that may not know?
Sure. So value investing is at its core, it's getting something for less than you believe it's worth. So it's kind of like, when I was a kid, whenever there was a sale racks, that's where we got our school clothes, right? So it's kind of like shopping like that is the very basics of it. Now, usually with value investing, you want to have some sort of margin of safety. So there's an investment firm named Tweedy Brown, and they did a study about a 100-year look back on what has worked in investing, and it's a PDF. I think it's still on their website. And really, the two things that work the best in investing over the last 100 years, according to the Tweedy Brown study, is buying assets for less than for low PE, so low earnings, or low assets, right? So basically below book value or around book value. And I think that really the effects of compounding and value investing are understated. You look at someone like Warren Buffett, who obviously is like the king of value investing, right? He made half of his money from when he started until uh, about 10 years ago. And he made the other half of his money in the last 10 years. That's insane, right? So that kind of tells you like the effects of compounding, I believe. Now, with regards to AI, and I was looking at Nvidia today, and Nvidia for the first time in a while is trading under $100 a share. So there may be people that think that that's a value investment. So you can still invest in AI, you can still invest in technology, and you just got to pick the right companies from a value perspective. You look at a company like Apple. Uh, Last year they announced not only the largest buybacks for Apple, but they were the largest buyback program in the history of corporate America. And this is a company that has nearly a 90% return on invested capital. For a company that's like $1 trillion market cap, probably more, um, that size to have that high of a return on capital is pretty insane. So um, I think that you can still invest in technology companies from a value perspective.
And so how does somebody go out there and find them, right? Especially, most people have financial planners or advisors, but we're seeing a lot more people are going the Robinhood route, right? Or self-directed retirement plans. And they're trying to find better ways to invest and find these companies. How does somebody identify that? Like, what are some of the principles that you tell people to look for?
Well, I think the most important thing that works in investing, Jeff, is you have to figure out what works for you. And that's kind of a cop out answer, but I've really found it to be true. There are people who have had great success being technical investors where they're kind of like chart readers. I have no idea how to do that. And there are other people that have made a lot of money in investing by being traders. And I don't know how to, I wouldn't be able to do that because that doesn't really fit my personality. It's too much activity, too many decisions, too much to pay attention to. I'm kind of more of like a slow burn, pen and paper guy. There's other people like George Soros who are macro investors and who have had a lot of success in the world by betting on these macroeconomic events. And so I think the first thing to do would be to study the different types of investing and figure out what works best for your personality style and for your investing style and your belief about, how the world works. Everyone's reality is different, right? So I think really getting to know yourself and your plans for your own capital are really important. How I go about finding these opportunities is I have around 50 companies that are on a list of what I consider to be, quote unquote, great companies. And I study these companies in depth. And when a buying opportunity is created, then I might look at investing in that company. So there's like 30,000 investable companies in the known kind of investing universe, depending on what broker you have, obviously, you're not going to even make a dent in looking at all of those. And so what I do, my approach has been, what are the qualities roughly, 5 to 10 qualities that I think a great company needs to have. And then I create a list of those companies, and then I study those companies and I wait. And it's can be very boring sometimes, and that's what's, worked.
Well, as with business, most of the money is made doing boring things over
Right.
and over and over again, right? We all want that flash in the pan, something to work tomorrow, but let's face it, that's just not the way life works.
Yeah.
So when you think about these companies and you say, okay, reviewing them and looking through them, what kind of research are you doing? Like, what are the things you are looking at? Because I think this is where a lot of people really struggle. I spend the vast majority of my time. Now we work with private companies, M&A, private investments, real estate, oil and gas, whatever. And I spend a lot of my time doing research and due diligence on companies before I ever bring them to a client. So I'm very familiar with due diligence methods. There's always something to learn. And I think most people underestimate the amount of research they can do from their own computer. So what are some things you suggest people start doing and some tactics they can actually employ to do this kind of research?
So there are tools available. I mean, it's 2025, so there's a lot of technology tools available. I prefer a tool called Value Line, and every week I get a new uh, like pamphlet in the mail, in the physical mail from Value Line, and it covers 3 or 4 industries, and each page is a different company in that industry, and each page gives me 10 years of financial history on one page, and a little bit about what's going on with the company. And so what I'm looking for are trends. For example, is the return on capital in a business going up or down? Is there earnings growth? Is there is the company diluting shareholders, or is the company giving money back to shareholders through dividends and buyback program. So those are really the things that I'm looking at is kind of the trends from that 10-year view. Um,
So really quickly, when you say return on capital, are you talking about like capital expenditures that the company's making and it's turning into more revenue and profits? Or what do you mean specifically by return on capital?
so I'm talking about return on the equity and debt, so total
Okay.
capital. Yeah, yeah. The other thing I think is a little bit understated is, and you probably know this, Jeff, there's some companies that are just an immediate pass. For me, there are whole industries that are an immediate pass. So, like pharmaceutical companies, I know nothing about that. Gone, right? Can't fit like healthcare usually is not a great category for me. I don't know much about it. Um, what are some other industries? Uh, Probably things having to do with like chemicals. I would be out. Um, Manufacturing, I'm good. Service businesses, I'm good. Technology, depending on the technology. Um, but so there's whole industries where I'm just not interested. So that makes it a very easy day kind of at the office where, there's a whole industry that comes in the new value line and I don't even have to worry about it.
Yeah.
The other thing that I like to do is just kind of back of the envelope math. Like, is this a absolute no brainer? Um, if everything's okay. If I start digging under the hood, based on what I know today, how bad does it have to get? And sometimes these things can be pretty hairy, as I'm sure, especially in the private world, they can be pretty hairy. And so that's kind of when you rely on your industry expertise. Um, and I read a lot. So one of the things that I really love is reading about marketing and branding. And a company that is, trading low right now is Nike. And I am not a big fan of Nike because they're running a huge discount program right now where they're discounting a lot of their stuff and they need to move inventory. My belief is that when a company runs discounts, it leads to short term sales increases. And over the long term, it harms the brand because people start to see it as a discounted product. And so I think that if I'm looking at an investment and for example, for Nike, I'm like, okay, do I want to own this for 10 years? I think that they're making mistakes that are going to harm them over the long term. And so I wouldn't be interested in a company like that based on my knowledge of branding and marketing.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
So you bring up some really interesting points there, right? Which is one, find the trusted resource that you like. You mentioned Value Line, I think was the name of the company. And then also identify industries that make sense. And I think this is where a lot of people start to, just from the very get-go, start to make mistakes, right? We watch the news, heaven forbid. You listen to the talking heads on TV, the Mad Moneys, the Kramers of the world, or whatever it might be, and you just blindly follow whatever they're saying, right? Or you think that they, like Jim Cramer, probably a very, very smart guy. I don't know him personally. He has a lot to say, but let's face it, how can he know everything about every single industry, let alone every single company, right? I know he's being fed information, but regardless, doing your own research is important. It's paramount if you're going to be taking control of your own finances, your own investing. And I think that in order to do that, you have to have some understanding of industries in general.
Uh-huh.
And if you try to say, like, for example, you mentioned a few, like the pharmaceutical industry, the healthcare industry, like pharmaceutical industry is a massive black hole for a lot of capital.
Right.
And if you start looking at, especially from the standpoint of we're putting drugs through various trials and whatnot, and now we have to invest in that, study, that research, everything like that, with the hopes of it making it big down the road. And I will tell you, those people are great salespeople, and they can sell your investment all day long too, because they're selling you on this hope and dream, right? That they're going to have this next $1 trillion drug or whatever it is. And so I think it is really important that people not only identify the things that they like and they feel comfortable with, but also, like you just said, is find the things that you absolutely know nothing about that you want to stay away from. I think if you just take that approach, and you cut out all the stuff that you don't know anything about, and you have a little bit of hubris there, and make sure that you check your ego at the door, I think you'll be a lot more successful right off the bat.
Yeah, I think you're totally right, Jeff. And you know, there may be people in the pharmaceutical industry who are experts in those types of companies, like based on their background. Like you may have a lot of expertise or insight in defense industry stocks, for example, because of your background. So I think that also paying attention to what is trading like very low, I think is important. So, every week I'm looking at what are the worst performing industries right now, because that's usually where you'll find value too, is in kind of the worst, maybe the best company in the worst performing industry. So for the last few months, well, I guess probably starting about 6 months ago, the Latin American index, which is called like MSCI Latin America, was trading down 20%. So within that index, there might be some really good companies. There's like Coca-Cola Mexico, right? They're not selling 20% less Coca-Cola probably. So kind of looking in those nooks and crannies for value, I think is important.
Now, let's transition this. And, obviously people are going to be making their own decisions when it comes to investing. And when you get to a high net worth status, you generally have a lot more options available to you, right? As you become an accredited investor, there are things that people will approach them about on a regular basis. They might be seeing folks like me, giving presentations on different investment opportunities. What are some things that these people need to think about when they maybe don't have all of the research available? Like a public company, you can go and read and you can gather a lot of information reading Berkshire Hathaway's annual reports and looking at the footnotes and all of that, right? When it comes to private investment opportunities, or even whether it's real estate or like you got started in the oil and gas world, there's a lot of research that people still need to do, but they don't necessarily know where to find that information. So
Yeah.
what are some principles they can at least apply, beyond a couple of other things we've already talked about? What are some other principles they might be able to apply so they can start to be a little bit more educated before they make an investment decision?
That's a great point. There are a lot of alternative investment options these days. And I think that on the one hand, you have the people side. So, I'll call them, promoters or fund managers, depending on the structure. So, what is their background? What is your trust level of them? Because trust is really important, like it is folks' money, right? And so, do you have friends who have invested with them? Or when you do a background check or even a Google check, I think can save you 90% of your heartache. If you run a background check or a Google check on someone and there's newspaper articles that come up about them being not a great person, then maybe you might want to pass on that. So there's some basically like rudimentary things that you can do. I think that when it comes to entrepreneurs, Jeff, who are presented with alternative asset investments, a lot of the entrepreneurs that I encounter, they don't really know the numbers of their business. So they don't really know what their return on invested capital is in that business. And a lot of times, from my perspective, the best investment that you can make is in your own business, because you know that business, number one. Number two, you have control of that business, and having control and being an owner inside of that business, that entrepreneurial structure is super powerful, right? You can have really great returns in a private business. Um, and so I think first I would want to know, like, why aren't you investing in your own business right now? Now, a lot of people like to diversify outside of their business, and that's definitely a personal preference. And I think that what I see folks do is they'll invest in things that maybe have high yields, and they may not understand some of the tax consequences of that. And so I think really talking to your advisors, and if you have advisors like tax accountant, financial planner, maybe you have a lawyer that you work with for your family, getting those folks just, hey, I want to start an investment program. Here are the types of investments that I want to do. What are the implications? What do I need to think about with this? Because I mean, it's your family's capital, so you should treat it, seriously. In my opinion.
Absolutely. I think, what you just hinted on there is really important. When you're sitting on the investment side, one of the first questions that we like to ask is, how much have you put into your own deal? You know, I mean, there's sweat equity, yeah, and we expect every single founder or promoter to have sweat equity, but actual cash, right? Because nothing speaks louder than I've put all my money into this thing and I'm going to make it work come hell or high water, right? And I think that's a really important question for people to be asking when they can't do all the other research, right? A lot of the times, I mean, there is a ton of research you have to do when it comes to any private investment, um, but it's challenging, right? And I think the first thing that anybody should be looking at is, okay, well, how much of your own money have you put into your deal? Because that's going to tip you off really quickly to how much that person believes in it. Are they all in? And no matter what, they're going to make this thing work, which means they're going to work their butt off without whatever money you give them? Or is it like, oh, well, I'm just giving you my time and my energy? All right. A flippant attitude like that doesn't really go very far in entrepreneurship, right?
Yeah, I have a really good friend who runs a venture capital fund, and we talk a lot, even though we invest in very different things. And he said, number one, with this venture capital stuff, at least in his opinion, he said everything's a lottery ticket. And he said, and I can tell you, Zach, the people that you invest in really, really matter. Like when they look back at the um, successes that they had, it really came down to what they call founder risk, right?
Mhm.
Which is this founder going to flake? Are they going to be able to handle the pressure? Are they determined? Can they lead a team? Can they recruit people? Can they be coached? Which is a huge one that a lot of folks don't talk about. But I think that being coachable as a founder is like, if you're not coachable, you're going to have a hard time.
Mhm. I think that's huge. Um, you know, some of us have got the gray hair now that because we've gone through the ups and downs, right, and had to take the lessons from the school of hard knocks. But um, you know, if we were more coachable, maybe I'd have a little bit less hair or a little bit more hair. I mean, a little less gray hair at this point. But I think that's so important, right? Because the coachability factor. I don't care if you're 13, 30, or you're 60 years old. We don't know everything.
Right.
And when you're looking at investing in the team, like your friend was saying, the people are the most important aspect because with almost every venture that I've ever studied or invested in, the final product or the thing that made them successful was not the initial vision. It's very, very seldom that the initial vision is actually what came to light because they had to make changes along the way. And if you don't have an adaptable team, a coachable leader, a strong leader that can help, like you said, rally the troops, so to speak, it's very difficult to weather those ups and downs.
Mm-hmm. Yeah, definitely.
So, you know, when we're talking about, accredited investors, high net worth individuals, and they have all these opportunities available to them, what are some of your thoughts on, what they should be doing when it comes to capital allocation, diversification?
So I think that if you look at some of the wealthiest people and how they've achieved their wealth, it is not very frequently that they have achieved it through diversification. If you look at um, and I'm going to use extreme examples here. If you look at the Walmart family, if you look at Jeff Bezos, if you look at, I don't know, even Buffett just has Berkshire Hathaway. Now, that is a very diversified kind of conglomerate, right? But most people have made their money through concentration. And so I think that there ought to be some point in your wealth creation journey, maybe, I don't know, I'm going to throw out a number if I'm making this up, maybe 10 million. And you decide to start diversifying after that 10 million. Because the diversification is kind of what, protects the investment. And so if you have some dollar amount in your head where you're like, okay, let me get my business to this amount, let me get my liquidity to this amount. once I do that, then I'll start diversifying. And I see diversification as kind of a protection of capital mechanism, right?
Yeah, I mean,
Um,
Warren Buffett even says diversification is a protection against ignorance.
yeah,
And I think that's really important for people to understand. It can be a good thing or it can be a bad thing, however
yeah.
you look at it.
I think that when it comes to investing in publicly traded companies, I think that it's easy for fund managers to hide behind over diversification. And I think that they can, if you're running a fund and you've got 100 companies in there, that's basically an index. So it's kind of easy to hide behind that. Very difficult to hide behind portfolios that you're running that are 3 companies, 10 companies, maybe even 15 or 20 companies. That really is a performance. Like you're looking at a lot of alpha there in portfolios that are that small, right? So and it really depends what people are comfortable with. I have been, helping family members with their investments for, I don't know, probably over a decade. And a lot of them are in Berkshire Hathaway, which I really like as an equity choice. And sometimes they freak out about just having one stock. And I'm like, well, today, for example, inside Berkshire Hathaway is also $335 billion of treasury bills and a
Right.
huge equity stake in Apple, Coca-Cola, Domino's, all this other stuff. Like you're going to be fine. Right.
Yeah.
So I don't know. Money is emotional, right?
It 100% is, especially the longer we get in the tooth, right? The closer we get to not being able to earn more money, the more emotional it gets. And I think that's where, if people have not planned properly in the very beginning, then it can be a very emotional ride. And I don't think that's what anybody wants, right? The closer you get to retirement or, wanting to just put the earning years behind you, the more of a kitty you should have, the bigger of the net worth you should have. And I think diversification can help ease a lot of people's minds when they get there.
Yeah, definitely, definitely. And I mean, I think that I talk to, investors and prospective investors in the fund, and some people just like owning things that they can touch. That's why they really like, at least in Houston, the big thing is like multifamily real estate. I think that's maybe a thing
Yeah.
in the South or all over the country. I'm not sure. People like investing in things that they can see a picture of and they can, you know, in their minds, they can touch it, right? Some people are just tangible investors. And I totally get that, people have preferences. There are some people that will just do nothing but bet on founders that they really like, right? And like forget the business model. I really like this guy. I see a lot of, and there are people that have made really good money that way. So there's just so many different ways to invest, Jeff. I think that it really just depends on the person. It depends on what you're looking for. And I also think that one thing, when you run these calculators on retirement income, compounding calculators, etc., they don't account for mistakes. And I probably made a mistake today. That's just life, right? Like you can't, it's really hard to grow as an investor, I've found, if I'm not a little bit bold in some areas. Last year in the portfolio, I got bold in one or two areas in a way that I hadn't done before. And I made a mistake and it definitely cost us some returns. And that's a mistake I hopefully won't make again. And that's how I grow as an investor. I mean, you learn so much from your mistakes. If you're getting it perfect all the time, I gotta feel like that's a really hard way to learn.
That we could go into a whole topic on just that alone, but you actually teed me up really nicely for my next question, which is knowing everything you know now, having gone through where you are, gotten to where you are in your career and gone through all the things you've gone through. What is one piece of advice you would love to be able to go back and give your younger self?
That is, I mean, don't sell the winners. That's
That's a good one.
The stuff that's making money and is not. Now, sometimes in private investments, especially if you're active in that investment, it can be a winner and it can be a struggle, like stressful if you're involved in the startup or whatever. It can be a struggle. And so I think that that's kind of a different thing. Just in equity investing, um, not selling the winners. I haven't had a lot of experience like riding companies all the way down to zero. That hasn't really happened to me. And selling winners is something that I've done in the past, and definitely a learning opportunity for me there.
Very cool. Awesome.
How about you?
Well, oh man, I keep listening to all the people like you and have so many things. I would just say, continue to be bold, right?
Yeah.
You know, timidity, I think, is what kills most dreams.
Hmm.
And so being bold is necessary. One of my core values is fearlessness.
That's amazing.
And it's that you have to go out there and do the hard thing, do the thing that is going to get you closer to your goal, even though it's going to hurt, it's going to suck, you're going to get setbacks. You got to be bold and just face it for what it
Yeah.
is.
I, I that actually really resonates with me because my bold move for the year or last year was, when I started this fund, it was a deep value strategy. And really, I took a lot of time to think about the strategy, to think about the future. How do I not completely avoid mistakes, but how do I make it less likely to make mistakes? And so I realized that I needed to change the fundamental strategy of the fund to look for great businesses that are, relatively fairly priced instead of bad businesses that are super cheap. Because when I choose the great businesses, I basically only have to get one decision right, and that's the buying. When you buy terrible companies that are trading cheap, you have to get the buying and the selling right. And that's too many
There's a
decisions.
lot of variables.
Yeah, there's a
A
lot
lot
of
of variables.
variables there. So that was my bold move, was changing the strategy, and I'm really happy to do it. And it takes a lot of courage to make changes, and I wish I could do it fearlessly. I still have fear sometimes when I have to go through those growth opportunities. I haven't yet figured out how to do it fearlessly. I think I'm getting a little bit better at working through that though.
It's a lifelong process. I wish I could say that nothing scares me, but that's not the case. It's just, you had to feel the fear and do it anyway, right?
Well, there's a lot of
Um,
people that are scared this week too in the markets. I mean, everyone's
oh,
seeing
sure.
red in their portfolio. I'm getting calls
Yep.
from family, friends, business associates. What should I do? Should I sell everything? And I'm like, please. It's hard today because everyone's so connected to everything.
Yeah.
Twitter, CNBC, Facebook, LinkedIn, it's everywhere.
Yep.
And
The
so,
president makes one tweet and you see the markets go down.
yeah, and people are seeing in real time their portfolios just dropping. And there's a study like 20, I don't know if you ever heard of this study, Jeff, by Fidelity, like 20 years ago, and they studied their top performing accounts. The top performing accounts, one, people who forgot their password, two, people who died.
Oh my gosh, that is hilarious.
So, like, I'm just like, just do nothing.
Yeah.
Do nothing.
Yeah. Yeah.
And it's hard
Things have
because
a
it's
way of working
scary.
themselves
I
out.
get it. I mean, it's, my mom's 74 and she relies on her portfolio, right? And she's a retired school teacher and she had plans. And she's like, I just lost X number of dollars. I'm like, no, the numbers change. The underlying value of the assets has not changed depending on, what companies you bought. Those are numbers that have changed. So, yeah, it's interesting. Human psychology.
It can be a bear. There's no doubt about it. All right, Zach. Well, I know people are going to want to look you up and learn a little bit more about you and your firm. So, how can people find you online?
Sure. They can just Google me, Zack Oliva. My name's here on the screen. Or you can visit olivapartners.com and I'll send you the link for that.
Beautiful. Well, we will make sure we get all of that information in the show notes. You have been listening to or watching the Angels, Exits, and Acquisitions podcast. I'm your host, Jeff Barnes, here today with Zack Oliva. Zack, thanks so much for being here today.
Thanks, Jeff. Thanks for having me.
You bet. Take care.